We're analyzing United Rentals stock ticker URI to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for United Rentals. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing United Rentals for your portfolio. Before we get into these valuable metrics, let's understand United Rentals stock performance. Right now, United Rentals trades for $350.23 per share. In the last year, their stock price is up nearly 16%. This is crushing the S&P 500 during this time. In the last 5 years, United Rentals is compounding at 17% annually. In the last 10 years, they're compounding at 22% annually. Going back prior to the global financial crisis, in the last 18 years, United Rentals is compounding at 18% annually. The company is up more than 70 times from their lows in February of 2009. Their stock performance has been killer over the last 2 decades. Right now, United Rentals has a 1.6% dividend yield. They just started paying dividends in 2023. This would be in addition to their compounded annual returns. United Rentals is trading snugly between their 52-week low and 52-week high. About 4% of their shares are sold short. United Rentals is a large business. They have a $24.5 billion market cap. But why should we be paying close attention to United Rentals? United Rentals is the world's largest equipment rental company and principally operates in the United States and Canada, where it commands approximately 17% share in a highly fragmented market. It serves 3 end markets: general industrial, commercial construction, and residential construction. Like its peers, United Rentals has historically provided its customers with equipment that was intermediately used, such as aerial equipment and portable generators. As the company has grown both organically and through hundreds of acquisitions since it went public in 1997, its catalog now includes a range of specialty equipment and other items that can be rented for indefinitely long periods of time. The company operates a network of over 1,500 rental locations. It was incorporated in 1997 and is headquartered in Stamford, Connecticut. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. This is for 2 reasons. Over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns will be captured here by return on capital. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in some margin of safety based off the overall quality of the business. United Rentals has increased their returns on capital throughout this time. They earned just under 15% returns on capital in their most recent fiscal year, and averaged out in these last 5 years, United Rental earns about 12.7% returns on capital in a given year. While that's solidly above a typical business, that's very close to our benchmark, but it's just below it. This means this is an X for United Rentals on metric number 1. Metric number 2, we're taking a high-level look at the growth of their business. We're looking for revenue, net income, and free cash flow growth in the last 5 years. All of these have to be up for this to be a check. This metric is all or nothing. During this time, United Rentals has grown their revenues by 54%, their earnings have more than doubled, and their free cash flows have grown by 31%. This is strong growth across the board for United Rentals. This is our first check of the day coming in on metric number 2. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years for United Rentals. As we learned, their earnings have more than doubled over this time. Their earnings per share have grown even faster than this because the company has bought back 16% of their shares outstanding. This is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a business buys back its shares by decreasing the number they have outstanding, they're increasing your ownership percentage in the business, which ultimately increases your percentage of the business's profits. They're doing this without you having to spend a dime. It's almost like the company's making a partial acquisition of itself. Just like with any acquisition, we want the business to be getting more value than the price that they're paying. There are a couple of factors that will determine this, including the price that these buybacks occurred at and what an estimate for a fair intrinsic value of United Rentals would be. Thankfully, we'll be coming to 2 calculations of that later in our video. You don't want to miss those. Again, between their strong earnings growth and their share buybacks, this has led to strong earnings per share growth. This is another check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years for United Rentals. Their free cash flows have grown by more than 30%, and with their 16% share buybacks, this has led to strong free cash flow per share growth. Another check here on metric number 4. So far, through our first 4 metrics, we have 3 checks and only 1 X for United Rentals. But there's one vital piece missing. You might think nailing high returns on capital and having strong growth is the key, But we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow United Rentals has produced in their last 5 years. United Rentals ended their most recent fiscal year with about $12.1 billion in net debt. Currently, they have about $12.4 billion, and in these last 5 years, they produced $8.3 billion worth of free cash flow. That's coming in about $4 billion below their current net debt position, meaning this is an X on metric number 5. It doesn't look like their net debt is supported by their free cash flows. To learn more about this, you'll want to dig into the company's filings. They'll break out how this debt is structured, when it matures, what rates it's at, and if there are any covenants associated with the debt. We have 3 checks and 2 X's through 5 metrics for United Rentals. Before we get to our next metric, it's time for our bonus. As our bonus, we're looking at United Rentals' dividend profile. United Rentals just started paying out dividends. Right now, United Rentals has a 1.6% dividend yield. It's not a surprise the company has supported their dividends with their free cash flows. It's great to see United Rentals has grown their free cash flows over this time. Depending on their debt situation, their dividend could be sustained going into the future. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a valuation of United Rentals. United Rentals has just under a $37 billion total enterprise value. This takes into account both their market cap and their net debt position. It gives a perspective of the business that's more similar to as if United Rentals were a private company. In the last 5 years, United Rentals has produced $8.3 billion worth of free cash flow, meaning in an average year, United Rentals produces $1.6 billion worth of free cash flow. When we divide that by their $37 billion total enterprise value, that gives us about a 4.3% average free cash flow to enterprise value yield for the business. On a current basis, United Rentals has produced just about that same amount of free cash flow in their last 12 months, meaning they have that same 4.3% current free cash flow to enterprise value yield as well. Both of these are slightly above the yield of the 10-year treasury, yet they're just down from that risk premium we'd be seeking, meaning this is an X on metric number 6 for United Rentals. Just because this is the case doesn't mean you toss out this business. This analysis is not a buy or sell recommendation of any security. It's not financial advice. Stick around as we come to a more concrete estimate of United Rentals' fair intrinsic value. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze United Rentals, which takes us on to using a discounted cash flow model to come to an estimate of their fair intrinsic value. A DCF model is based off the predictability of a company's free cash flows. It's like any model in any discipline, its outputs are sensitive to its inputs. Starting with an average of United Rentals' free cash flows in their last 5 years, then projecting these into the future using historical growth assumptions, it's up to you to do your own homework to figure out if these are accurate and applicable for United Rentals. Assuming United Rentals grows its average free cash flows at a rate of just under 8% annually for the next 10 years, then assuming this growth rate is nearly cut in half to 4% for the 10 years out from there, if we add in their tangible book value, which gives us an estimate of their net worth, if we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, it looks like at today's valuations, an estimate of United Rentals' fair intrinsic value is only around $122 per share. Their current stock price would be more than cut in half to get to this number. There are key points to keep in mind. United Rentals has had a very high degree of business predictability in its past. That's no guarantee for the future. This could change. Their slight dividend yield would also be included in this 15% discount rate. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, consult with your financial advisor. In just a moment, we'll give our rating to United Rentals, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, United Rentals' growing focus on building up its specialty fleet could lead to higher dollar utilization and increased profitability. Number 2, construction and industrial spending may continue to recover from pandemic lows, creating demand for United Rentals products. Number 3, increased equipment rental penetration in North America could result in more general equipment rentals, driving higher revenue growth for United Rentals. Then the key points supporting a potential short thesis. Number 1, a weaker potential economic backdrop may force end users to hold off from renting equipment until new project demand picks up, pressuring United Rentals sales. Number 2, the recovery of construction and industrial spending could be disrupted, keeping demand for United Rentals products soft in the near term. Number 3, rental customers may elect to buy equipment outright instead of renting, which could lead to a decrease in the rental penetration rate, ultimately meaning lower sales for United Rentals. There you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time to give our rating. In analyzing United Rentals, stock ticker URI, we learned the business earns above average returns on capital of just under 13% annually. They've strongly grown their revenues, earnings, and free cash flows in the last 5 years, repurchasing 16% of their shares outstanding at the same time. The company looks like it's using more debt than their free cash flows can support. However, this depends on how this debt is structured. On both an average and a current basis of their free cash flow to their enterprise value yield, those were both coming in at about the same rate, just slightly above the yield of the 10-year treasury, but below the risk premium we'd be seeking. Of note, United Rentals just started paying a dividend in 2023. The company's prioritized a couple of different ways of returning capital to shareholders, which will have to be balanced against their debt repayment. It's worth reiterating this analysis is not financial advice. Performing a discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations, an estimate of United Rentals' fair intrinsic value is only around $122 per share. The company last traded at those levels in May of 2020. You'd want to be patient as you dig in and learn more. With all the factors of our analysis, United Rentals looks like a moderate candidate for further research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about United Rentals with me, and have a great day.